Hello and welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Olivia Grace-Curran. Global stocks fell on Friday following surprisingly strong US jobs data, which pushed back market expectations for further Federal Reserve interest rate cuts. Wall Street's main indexes finished lower, with 10 out of 11 categories of stocks in the benchmark S&P 500 closing in the red, led by financials, real estate, technology and consumer staples. Shares in small cap companies came under the most pressure during the session, pushing the Russell 2000 down 2.22%. Pharmacy operator Walgreens Boots Alliance, one of the best performers on the NASDAQ after the company issued its earnings results. Shares of US-based electric utility Constellation Energy soared nearly 25% to an all-time high, following news of plans to acquire natural gas and geothermal electric utility Calpine Corporation, while shares of Delta Airlines rose on a higher-than-expected 2025 forecast. Corona beer maker Constellation Brands shares slumped to a more than 4-year low after the company cut its annual profit and sales forecasts on muted demand for alcoholic beverages. And chocolate maker Hershey's shares fell following a report that CEO Michelle Buck is set to depart by 2026. Strong US jobs data has raised doubts about further Federal Reserve rate cuts after the labour market ended 2024 on solid footing. US jobs growth unexpectedly accelerated in December, with non-farm payrolls increasing by 256,000 jobs, well beyond economists' predictions, while the unemployment rate dropped from 4.2% to 4.1%. The upbeat employment report released on Friday supports the Federal Reserve's cautious stance toward further monetary policy easing this year, amid fears that President-elect Donald Trump's proposed tariffs could stoke inflation. Markets are now pricing in a single rate cut no sooner than June, which would mark the end of the Fed's rate-cutting cycle. Key data ahead of the central bank's meeting on January 28 and 29 will include consumer inflation for December, due this week. Treasury yields rose on Friday following the stronger-than-expected jobs data. The yield on benchmark US 10-year notes rose 8 basis points to 4.76% after reaching its highest level since November 2023. The US dollar rose to a 2-year high in response to the surprisingly strong US jobs data. The sterling touched a new 14-month low following the report, and the AUD fell from 62 cents to 614, its lowest since April 2020. While Bitcoin is down, currently 93,800. Well, oil prices rallied nearly 3% to their highest in 3 months on Friday as traders braced for supply disruptions after President Joe Biden's administration imposed fresh sanctions targeting Russia's oil industry amid ongoing military attacks on Ukraine. Brent crude futures settled at $79.76 US a barrel, up 3.7% after crossing the $80 a barrel for the first time since October. Gold prices rebounded as uncertainty surrounding the incoming Trump administration's policies lifted safe haven appeal. Spot gold was up 0.6% at $2,686 US dollars an ounce. Meanwhile, benchmark copper prices have touched the highest level in nearly a month, propelled by firmer demand in top metals consumer China, with 3-month copper 0.1% higher at $9,090 a metric tonne. Well, for more on what's moving global markets, Rob Shears from Valor Private Wealth joins me now. Rob, great to have you in the studio.
Thanks very much, Olivia. So
we saw global stocks slump on Friday following that stronger than expected jobs report. Just how bad was it?
We've been expecting the US economy to be the least worst place in the world for quite a while now. They've got a lot of they've got the 4 pillars of their economy, which is sort of, I summarise it in 4 different cities. There's San Francisco with the tech, which is absolutely booming. There's Los Angeles, which is obviously the entertainment industry. There's Houston, which is the oil, and there's New York, which is finance. And all those 4 pillars are actually doing really well, which is supporting their economy. So we've been saying that for a while, and I don't think anything's going to change. Those 4 pillars are likely to continue doing well for many, many years to come.
And so this jobs report, we saw 256,000 jobs added, further showing signs that the economy is going strong and that the Fed may have to be cautious, as they had indicated. Do you see any changes based on the data from Friday?
We don't try to predict short-term interest rates or short-term. I mean, I don't think anyone in the world can really predict these things accurately. There's a lot of moving parts. We do have a thesis that Airbnb is a much bigger part of the inflation figures than people realise. Airbnb is sucking out long-term rentals on a global basis and driving up inflation and holding inflation up more than most people realise. And rent is the largest part of inflation. So Airbnb is a big part of the inflation story, and I think people just haven't realised how much of a part of that is. In the US, it's over 40% of inflation figures is actually rent and housing, and I think that Airbnb is causing two things: it's sucking out long-term rentals, causing rents to go up on a global basis. This is not just happening in Byron Bay and Zetland. This is happening everywhere in the world, including in poorer countries, in Greece, and wherever it's going to be. So it's happening everywhere in the world. But the second part is, and it's allowing people to not have to force sell their homes and stay in their homes because they can rent out their homes to supplement their income much better than they used to.
Well, on that, I suppose, how do you see that market faring given the fires through California and its impacts?
Look, I think the short-term effects of the fires will be, obviously, the insurers will get hit somewhat depending on different insurers. So quite a few of the insurers did pull out before this because the regulations forced them out. So we know that Berkshire Hathaway, Warren Buffett talked about this in, I think, 2018, 2019 annual general meeting, talking about how they'd basically pulled out of reinsurance in California because they were forced to. By the regulators. So they don't have as much exposure as a lot of people may think. But certainly this probably will lead to changes in regulations, and also I think that there will be increased insurance costs, and that's just going to keep on happening due to global warming. These insurance policies are priced year on year, and as they get repriced annually due to global warming, they'll certainly be higher over time, and that'll actually increase the profits of these insurance companies.
And Trump's inauguration is about a week away now. So what will you be keeping an eye on in coming days and when he does come to power?
There's a lot of moving parts. Nothing happens in a vacuum. So if Trump enacts a policy on one area, the currency can offset it in another area. There's always gives and takes in every economic policy, which is why I don't believe that any politician has as much effect as some people believe. If you look back in the last 100, 200 years, there's been some really bad presidents and really good presidents. And if you try pick which each president was on a stock market chart on the effect they had on markets, and we're just talking about market effect here, not social effects, it's almost impossible to pick where each president had their moment of 4 to 8 years. So I am a person that believes that the pendulum swings left and then right, and always ends up at the centre. But there's forces which bring the pendulum back and offset each other. So I don't think that politicians have as much effect on the economy as something like AI does. Not even close.
And okay, let's talk about, have you been keeping an eye on AI and the conference last week?
I haven't. I missed the conference. I was actually on holidays in the US. It just got out before the fires started. So it was burning as I left. It was a very surreal as I saw the smoke and the flames. But it was very sad.
Great that you're here safe. Okay, let's talk about temporary employee CEO versus owner operator. Now buybacks. You say, Einstein was rumoured to have said that compound interest is the 8th wonder of the world.
Yes, and I think that buybacks are the 9th. I think that a lot of people don't realise that buybacks can be probably one of the most beneficial areas to their portfolio of any sort of metric. And some of the companies over the last couple of years have bought back significant amounts of shares, and we own one of them, Synchrony Financial, in 2022, bought back 24% of shares in 1 year. So you look for these great companies, eBay, NVR, which is a home builder in the US. There's been some fantastic stories of buybacks, which some of these companies are doing well over 20% in 1 year. And we own Waypoint REIT in Australia, which did 26% over 3 years. So if you can have a $100 company divided by 100 shares, you get $1 a share. If you can have a $100 company divided by 50 shares, you get $2 a share. You've doubled your money just from buybacks, just from halving the number of shares. But remember, the $100 company is still a $100 company. The company doesn't need to grow to make money. And this is where a lot of people focus on the revenue growth of the business and not looking at, okay, where's the capital allocation of these CEOs? We talk about permanent CEOs and temporary CEOs. The permanent CEOs are the ones that usually own lots of shares in their own company. They've got all of their net wealth in that business. They are like the pilot on the flight to Los Angeles. They want to get there because they've got skin in the game. They are in that business and 100%. The temporary CEOs who are flying that plane from the ground aren't on that plane. They don't really care. The temporary CEOs often there for only 3 years, and they often make really bad decisions like capital allocation, and most buybacks are destructive to the share price, most.
And so do you keep an eye on those companies that might have those temporary CEOs?
Yes, and we avoid them like the plague. So we have a list of CEOs who've been CEOs of previous companies, and I will never invest in anything that CEO does at any future company. So a lot of these CEOs jump around, 3 to 5 years, and then it's like, well, okay, that's uninvestable. They're uninvestable people. They are there with the wrong incentives, and they make very bad decisions, to the point where I think Warren Buffett estimated that 80 to 90% of buybacks are actually destructive.
All right, well, okay, let's just check, come back home locally in terms of the RBA. Now, on Friday, the ANZ changed its call on the RBA rate cut to February from May. How important do you think data will be leading up to that last meeting with that current board that will be held in February?
Look, it's going to be a tough call because there are still inflationary pressures in the system. So whilst inflation has come off from where it was the last couple of years, I don't think they've got the cat yet in the bag. And inflation is one of these things that if you get behind the curve, it can really run ahead of you, and it's very, very hard to catch up. As I said, Airbnb, I can't falsify my thesis. I can't say, rightio, let's just get rid of Airbnb and see what's happening. So Airbnb, I do think is certainly, and I see this from my clients, a lot of my clients are just putting their houses on Airbnb and supplementing their income or getting much higher income from that than they would on long-term rentals. Airbnb is a force in inflation. If you have 5% rental vacancies and 2% rental vacancies, at 2% rental vacancies, rents are going up. At 5% rental vacancies, rents aren't going up. Airbnb is taking out 3% of global rental vacancies. It's gone from 5% down to 2% in a lot of places in the world. It is a force of inflation. It's not calculable or falsifiable, that thesis, but I am certain that it is a big part of inflation. So the RBA has a very difficult decision because they're using short-term data to make what potentially could be long-term decisions. On the other side, I think that AI could be enormously deflationary, but that's probably 2 to 5 years away. I think that AI is going to take more jobs than most people think. Somewhere in the order of 10 to 30% of jobs could disappear in the next 2 to 5 years. AI is coming faster than most people think, and it's improving faster than most people think, and a lot of jobs will not exist in the same way we think they will in a very short space of time. If you go from 3.7 or 4.1% inflation, 4.1% unemployment to 14.1% unemployment in 2 to 5 years, that's extraordinarily deflationary. So we've got this push and pull, and I don't know which one wins in the short term. I'm not making any bets, but I do think that both those forces are some of the biggest forces on inflation that the world's seen in 50 to 100 years.
Interesting. Well, we'll have to see how it all plays out. Thanks so much for joining us.
Thank you.
Rob Shears from Valor Private Wealth. And just before we go, one final check on where the local market is set to open. When trade gets underway, SPI futures are down 71 points. Well, that does it for this edition of The Global View. Stick around, the open is coming up next.